talking about farmland and specifically farmland affordability. Last fall, Randy and I joined you all looking at farmland values relative to income it generated. But now we're going to talk a little bit about cash flowing the farm. It's a little bit of a different, sort of a similar idea, but it's a little bit different when you think about, okay, I'm going to buy this farm now. How am I going to take care of getting it paid? How do I make sure I have enough resources to get that covered? So I'm going to kick this off. Randy's going to jump in as we move through here, and then of course when we get to the end of our prepared comments, we're going to open it up for any questions that you all might have for Randy and I. So the first idea that I wanted to put together here is a look at, and we haven't looked at this in a while in our AEI content, but I think it's a really important one. It's looking at the down payment to buy a farm at different points throughout history relative to the cash rental rate that's prevailing when you make that purchase. And so these are Indiana farmland values, Indiana cash rents. We assumed a 35% down payment. We assumed so that's consistent. That 35% down payment is consistent every single year. These are the Purdue data. If you're familiar with them, it's a really good data set. And then this chart here, the axis on the left side here, it's showing us how many years worth of rent that down payment represents. Not surprisingly, as farmland values have increased since their low point in the 1980s after that farm financial crisis, they've been ticking higher from 4 years worth of down payments, or 4 years worth of cash rent to get you a down payment in place. That went up to about 12 years between 2012 and 2020, and now it's been ticking higher, ticking up. We have this combination of farmland values that have gone up quite a bit since around 2020, and cash rents have been pretty strong, but not necessarily catching up as much with those farmland values. You have a really big gap here where now we have around 16 years worth of savings on an acre to make that initial down payment. Of course, it's not a one-to-one. Maybe you have a couple other acres that you can pull those rents from. But the idea here is it takes a lot of savings to get ready for a down payment on a new farm. It's definitely been trending higher over the last several decades and several years. And I think this is one of the first hurdles for a producer who wants to buy a farm is, how do I make sure I have enough working capital? How do I make sure I have enough savings for that initial down payment?
I think this is very important, David, and especially in light of lenders' policies. How much they're going to lend or the limits they'll lend on land, and that's changed over time from the 1970s boom era where they lend way too much on the purchase of a farm, and since then lenders have gotten more practical and conservative about that. And so some lenders set a fixed amount, dollars per acre, that they'll lend, and others will do a percentage and stuff. So this is very important because if you're working with a lender, how much money do you need to have, and how much can you borrow?
Right, that's a really good point, Randy. We just sort of use the rule of thumb here, but it's going to vary by organization and all the other factors that go into that underwriting process. The second chart is kind of a similar set of assumptions, but now we're looking at what is the annual debt payment as a share of the initial cash rent. So we're trying to get an idea here of how many acres worth of rent do you need to have to cover that payment. We all know that over time, cash rents tend to increase, and so that helps with that affordability 5-10 years down the road. But the first piece that we want to look at is, what's that relationship between initial payments and where we are today? So of course, this is as a percentage. So if it's 100%, it's a 1. So that tells us that the cash rent and the initial payment are about equal. There's a couple times in history, in the mid 1980s and maybe briefly in the early 1990s, where you could get really close to this 1, where that initial cash rent was the same as the payment. That's a really good deal if you're a young producer, if you're a producer wanting to buy land. You still have to have that down payment, but this idea is that you're kind of close to equal with respect to paying a rent versus that savings mechanism from the interest expense, but also the principal reduction. If you think back to the around 2010, that was around 150%. So you had to have about 50% more income than the rent to cover that additional payment. And then we worked our way higher throughout the 2010s. We almost got to 200. There's a little bit of a reset. But look what happened after 2020. We really surged this high. past 200, almost at 300. So the idea here at 300%, this ratio, you need about the 2 additional acres. So you need 3 acres total worth of rent to make that first year cash payment. So the farm you buy plus 200 acres. That's a pretty steep situation. It's a pretty big change of events. And again, I think this adds to this cash flow situation that a lot of producers, maybe young producers, maybe mid-career producers, I want to talk about this a little bit, maybe producers who are inheriting a farm and they need to buy out their siblings. This is all going to be part of this conversation about, yeah, maybe I'm really excited about farmland as an investment. I'm willing to take that cap rate that's implied, and I want to have farmland for multiple generations. But it's this cash flow obligation. How do I make sure I can cash flow it? Sometimes the cash flow conversation turns into a bit of the boogeyman, right? It's this outside investor that's running up prices and all these other issues. But we want to really focus on what does this look like if you're going to try to buy these farms?
Yeah, the old saying used to be that you needed to own 2 acres for every acre you wanted to buy, and that's kind of what that average and kind of proves your point right here. It takes more acres one way or other to make those payments.
So Randy, I know you have a couple slides you're going to walk us through here. This first one takes a look at this cash flow from a little bit different perspective. This is Illinois data, and there's a difference in the high quality versus average quality. So I'll let you talk through this.
Okay, thank you, David. Yeah, this one represents a 50% down payment. So I've seen different information that, the average amount of debt on new purchase of farmlands, I think 50 to 60%. So I just used that somebody had 50% to pay down on either high quality land, produces highest yields in Illinois, and then average quality would be more like South Central, Southern Illinois, or other places that just don't quite have the yield potential. And so I looked back several years and different price levels at that land. You can see the high quality land did peak kind of in 2024, has dropped some. So I was trying to be conservative in those values and the interest rates at the time and projecting into next year. So at that 50%, at those higher purchase price levels, 50% loan payment or payment on that loan still was very significant, as you can see. In 2024 is $840 per acre on the high quality and $496 for the average quality. Then I looked at the farmer's cash flow, and this again from University of Illinois and FBFM data, just looking at the direct inputs and fuel. So whatever the farmer's out of the pocket to farm those more acres. So the net of that, cost minus from the yield and projected prices at the time, the farmer's cash flow without government payments, I thought was an interesting context right now, especially over what's happening right now with farm policy and ad hoc payments. So you can see that line for both high quality and average quality land. Then I added in what the projected government payments were on an accrual basis and meant to that. So it's pretty significant, especially if you look at the average quality land for 2025. That's basically a 50% increase in that cash flow from $280 to $410 that they would have, as discussed earlier, to make payments towards those principal and interest. Then I also looked, because it's not only farmers buying land, but investors as an individual, and looking at some kind of the high market cash rents. So kind of push those a little bit minus real estate taxes. And that would be the investor's cash flow. You can see it's significantly less. I think we get into that later on also. So again, this is just a different way of showing that it takes several acres that you own free and clear, or hopefully making a profit somewhere on a rental terms on some land to make these payments. But it's also kind of investment into the future, into your bank account in the land. I did this back into earlier, kind of back up what some of David said to 2012 and 13, land prices lower, and looking at when interest rates were lower. And there were times with the high income years of 2012, 13 that you could cover the payment. but that was just very rare at the time from a high quality standpoint. So,
And Randy, what I really like about this is you looked at it as a little different down payment. So that changes things a little bit. But then I think you also take a look at this kind of this, we talk ourselves into rationalizing. It's like, well, as a producer, I want to get more than a cash rent value. I have all these other returns that I can make off that land. And you captured that here, and it still shows this deficit idea that more money is going to flow into these cash flowing the farmland when we use debt to make that happen. So another look here is investment returns versus operator returns.
yeah, this backs up kind of what I used in that previous slide, say how important the government payments were, through different time frames that was put together. So, of course, we all know that, when times are harder with the farm economy, that the government payments, the safety net, and this includes, I think, crop insurance subsidies and some things, are more important than when, grain prices and commodity prices are really good. And that it's common sense, but this portrays it how important it is. And in the last kind of few years, what we've gone through definitely makes a difference between losing money on the farm and maybe being able to break even, and how that impacts that payment you can make. Now, the question becomes when you're planning that land purchase is, what do you count on? Do you use that? Can you give it to the lender as, yes, I'm going to get these government payments, but what if they don't transpire like you thought or such? So you go from having this much cash, you think, to pay to this much. And can you risk that? Can you cash flow that otherwise? So I think this kind of portrays the importance of trying to figure out what you can do with and without farm payments.
Very, very good, very insightful. I mentioned earlier where this affordability gets to be really challenging, I think, is for younger beginning producers. That's something that you hear a lot from a policy standpoint, from some initiatives that you see at the state or even local levels. It's sort of these young producers don't have a lot of free and clear acres that might be necessary to subsidize these high payments, these additional payments that we need to put in these operations to subsidize that farm. So maybe it's an off-farm income story. I think there's a lot of opportunities for trusted advisors, from accountants to lenders to financial planners, to really help producers think about what's it going to take to buy a farm at the beginning part of your career. It might be a little more creativity to make that happen. I think the other challenge, it's a challenge for everybody, but I think the other challenge, and Randy and I were thinking about this when we were putting these slides together, it's maybe there's a buyout clause for some inheritance. And so this idea, there's this operation and it's going along, it's working pretty well for the first and second generation. And then there's an inherited situation where the operation still has the same amount of earning potential, the same amount of cash flow potential, but now maybe the other heirs, the off-farm heirs, want to buy. So maybe all of a sudden you have to buy out 50% of those acres. You're probably not going to have enough cash flow off that operation to make things work at today's environment of valuations and rent and all overall debt payment levels. And so I think it's going to be really important to think about those inheritance plans, those buyout clauses, how they might affect the cash flow of the operation itself. But it's a really tough situation if producers are having to buy land and they don't have a lot of other acres to subsidize that. They don't have that 2 to 3. So that idea of that rule of thumb range talked about 2 acres to make the payment on one. Well, now it's closer to 3. So you're in that 2 to 3 range. It gets to be pretty darn difficult.
Yeah, David, this is a very common occurrence, and especially now as we're talking about a lot of generational transfer of land, farmers retiring, exiting, and whether they have enough acres and their children, maybe that farming heir still farming it, how large an operation they have. So this really particularly hits that smaller farm size operation that maybe has, 400 or 500 acres, making a living on it. Part of it's rented, part of it's owned. And then, yeah, at this point, there might be 2 or 3 other siblings that do want to sell. And for that remaining farmer heir to buy that out is a problem. And so it takes some planning. It takes some other succession um, options in there to work. And today there are, some options to have fractional ownership if you want and do some things, but that's not necessarily what people either generation would want. So this is a tough one that need to think about ahead of time if possible.
And just to recap, to underscore this, the reason what's causing this over time is this relationship between how much income can the farm generate per acre and how much is that value of the farm per acre. And that relationship has put farmland at a pretty pricey spot here in 2026 and in recent years relative to that income coming through. So I want to switch gears just a little bit, and I want to ask this theoretical question. It's one that I always have to think pretty hard about because I have a knee jerk reaction. Is would you rather buy farmland when in a market where the interest rates are high or low? And I think my knee jerk reaction is, oh, I want low interest rates. I always want to buy these farms at a low interest rate environment. I think Randy, you had the opportunity of buying farms at both sides of that equation, so you've
Yeah.
lived through both of those examples. But one of the things that we want to share here is that a lot of times, I think sometimes it's a good effort, right? We want to offer low interest rate loans for young and beginning producers. I think that's perhaps a noble cause, and that it tries to reduce that interest expense. But we sometimes overlook how interest rates affect the borrowing cost, but also asset valuations. We tend to look at this on sort of a one-way street, when in reality, these things interplay. There are first and second order effects, and as to how interest rates affect the farmland market. So there's a lot going on this slide, and you all will have access to the slide and the recording to look through all of this. But the idea here is, how do cheap interest rates affect asset values and this cash flow story? And so when we take a look at is, we started with current cash rents in Indiana, $264 an acre. And on the left side of this chart, we said, okay, if the cash rent to value ratio is 2%, 4%, 6%, or 8%, what does that translate into a purchase price? And as you know, we're closer to this 2% uh, cap rate, or this 2% cash rent to value ratio, with farmland values, close to this $13,000 threshold. I think it's 2.2% latest data, but I use these rounder numbers for this presentation. So let's work through here. The first idea here is that as cap rates, or this cash rent, decreases, asset values go up. So low interest rate environment correlates with this high asset value. So we have down payments that are pretty high, especially when we look at them as a number of years worth of cash rental payments. We talked about that earlier. You can look at these annual debt payments and how those are going to increase quite a bit when we go from an 8% to a 6%. And of course, also, we look at this initial payment relative to the rent that we're going to generate in that first year. So again, this is getting close to that 3 ratio that we talked about earlier. We also know that the interest expense is going to increase over the time. So yes, these correlations between farmland cap rates and interest rates aren't perfect, but when we look at this kind of as a theory, as a back of the envelope, low interest, it's kind of counterintuitive to say low interest rate environments could actually increase my interest expense. Again, it's because of this asset value. If we can hold asset values flat and we can lower interest rates, that's a different story. But when we lower interest rates and it pushes asset values up and the borrowing costs on a percentage basis down, it does sometimes actually increase our interest expense. And so, last column, there's a lot going on in this chart. Again, I apologize. We want to walk through this in one succinct way, is this idea that how much money do I need to bring from the outside to justify this farm? Well, you can start to see how this compiles up here. A lot of outside money over the life of that loan to make sure we cover the down payment, the interest expense, and all the other principal that we're going to make payments on. If you get closer to this 8%, it's going to say, okay, we actually might be in a little scenario where we have less outside savings, maybe even positive over the life of the loan. We did assume cash rents would increase at 3% annually. That's one of the assumptions to make this chart play out. But again, the idea here is that borrowing costs are also correlated with high asset values. And so in the ideal world, you might lock in a low interest rate, but I guess in the real world, when you lock in a low interest rate, you probably also locked in a high asset value. And I think we overlook that asset value part a lot. The other piece here to keep in mind here is that in 2026, we haven't looked at this in this data specifically, but we're in this environment where we're at some extremes. We have really low cap rates. So I told you earlier, farmland's at about a 2.2% cap rate, but that interest story is around 5.5, or maybe 6% for farm loans. And so it's a little bit of an extreme here. So again, if you're thinking about inheriting land or you have young producer trying to buy land, you're buying land at a really low cap rate, but financing at a moderate interest rate.
Yeah, David, that works because I mean the what you've demonstrated is very evident in the fact also that it shows how the income generated by that acre is increasing at, we'll say that 3% rate per year over time. But over time, the land values have increased 5 to 6% per year. So the value of the land has outstripped the income it generates. And so it's just compounded that difference from whether you're a farmer and your income's flat and your margin's squeezed, hasn't really improved as the value. And that value of the land, you're paying for it, that higher value, you still have to cash flow that, but that higher value is not bringing you more income until you sell it, realize a capital gain, or it's transferred into the next generation.
Yeah, that's a really, really great point. So I want to wrap this up here with a little bit of a management insight or management framework for you to think about and either take to your operation or maybe share with the operations that you work with. And a question that I get a lot, and I know Randy gets it even more than I do, is should I buy the farm? So we share these ideas. We do a lot of writing. People still ask, should I buy the farm? And the idea that I want to share with you is that positioning is more powerful than predicting. So we could try to predict where farmland values are going to go, or these affordability matrices, or these affordability uh, ratios that I showed earlier, where they're going to go. But for a lot of us on the individual level, it's more beneficial for us to think about how we can position ourselves personally, but also our operation to be successful, whatever those outcomes might be. And so I have three scenarios, and again, Rain's going to jump in with his insights and observations. And the idea here is there might be three ways that someone's going to approach the farmland market in 2026. And we're not going to say this is right or wrong for them to use buy land or use these strategies or use debt or different levels of debt. We want to just lay out how you might position this to be successful. So, first example, I think we might hear this a lot. Well, I want to buy this land because it's a once in a lifetime opportunity. Maybe I need to expand for the next generation to come through. Maybe it's the neighboring farm. Maybe it's this home place that I've always wanted, the place that my grandfather had for his home place. Maybe I've always wanted to buy it. And if you find yourself in that situation, the positioning that you're going to have to face, the reality of this is that you're going to have to be willing to prepare to bid in a really low return and probably have a lot of acres to help subsidize the payments that might be associated with that or the down payments. So I think that strategy works. This prepared to bid in a low return, pay a high value, is if you have some strong income from other sources, maybe it's other land or off farm income or some other enterprises in the operation. Maybe you have some livestock here in 2026 that's going to help you get there in that position. The other reality is if you're waiting to buy that once in a lifetime opportunity, you're going to have to be willing to pass on other opportunities to get that down payment saved up. Or once you buy that land, you might have to pass and forego future opportunities because you're going to be in a cash flow situation where you have a lot of debt to service on that particular operation. And I think the other piece here is these once in a lifetime opportunities really work well if this is something that really fits into a long-term plan. And so I think sometimes you hear these stories about these dairies who have to have a manure management plan and so they can buy this neighboring farm and that allows them to expand the herd a little bit or apply the manure in a little bit more affordable way. That's how it fits into a really big long-term plan. So they're going to be able to capture these benefits over many years, decades, if not generations.
Yeah, David, this is a very common one. A lot of times it happens when farmers renting a property, that owner passes away, next generation, as we kind of talked about previously in different situation, inherits it and they want to sell it. And that tenant who wants to buy it, typically, especially if it's once in a lifetime, that farm that they've driven past, they've farmed it, they want to keep it. I experienced this. We were renting a property right connected adjacent to the home place of my parents, and we were farming it for a few years. And then, due to a divorce settlement, couple wanted to sell it. And so, we had our chance, wanted to buy it. It was 1983. Wasn't the best time to buy because land values hadn't bottomed. They'd come off a little, but, it was there. It was adjacent, and we bought it. And the good thing about it, it did coincide with property lines and things that we could do with drainage and fence lines and farmability and convenience. So it made a lot of sense at the time, even though the timing of it still wasn't perfect.
I want to switch to the second strategy here, and this is someone who's looking for a big return.
Mhm.
So they're looking to make an investment in land because they want to get a big return. A couple of the ways that this is going to really play out is timing is going to matter. The timing is going to be important, and a lot of times because you're going to have to strike when an opportunity presents itself. And so this scenario works great. Whenever you can be patient but decisive. So you might have to be in a situation where um, there's a maybe an opportunity for you to buy a farm when there's a seller that's in a little bit of a distressed situation. They want to make maybe it's a cash purchase or a near cash purchase or a pre-approved situation where they can get this closed in a short period of time so they can get the thing moving. I think also you might need to be open to some private party sales. You might need to be aware of what's on the market but not actually listed yet. So you kind of want to know what these what's available but yet fully listed yet. So that might be a way for you to move quickly, but also have a good ear on the ground, what's going on in the markets. I think you also have to be willing to walk away. Um, you have to be always ready to make a purchase and you have to know your limits. So if you want to have a big return, you have to be really disciplined about what it is that you can afford, what it is that your limits are, and just be willing to walk away if you're in an auction situation. And Randy, you suggested this. I think this is a really great one. Is maybe you're in a position where you're going to be able to make some improvements to the land. So maybe you buy a land that's not performing at 100%, and you're able to bring that up a little bit. Tell us a little bit more about that and maybe some examples.
Multiple ways that that happens. And this scenario is a lot of times how investment funds or groups look at land, trying to find that private party sale where a producer's wants to keep farming something but can't afford to buy it, so they look for that investor who wants to buy this quietly and lease it back, or that farmer needs to offset or sell some land for whatever reason, still wants to farm it and will make a deal with that investor. It could be individual or a fund. And so farmers are always looking for that type of a land buyer. But that land buyer typically, especially the funds, are looking at ways to improve that property. And that could be changing from drip irrigation, flood irrigation to high efficiency center pivot irrigations that can units that can still be done. Putting in drainage tile through the Eastern Corn Belt makes a lot of difference in the value of that land and how productive and the rent they can receive. Doing soil erosion, waterways, terracing, maybe fertility, whatever it is. In the Mid-South, a lot of times it's cleaning out drainage ditches and sloughs, and then doing precision leveling, zero grade leveling, so they have the option to plant, the highest value crops of rice more efficiently or something. So there's a lot of different ways. It takes some extra investment capital, but usually the return on that makes that farm more valuable and the income it generates more valuable. So now there are people, individuals and funds looking for this type of a buy. And as a farmer, you're looking at, I can make that farm better. So if I can buy that right, I can make that average farm into a top producing because of my farming ability. So farmers a lot of times depend on that.
My Great Plains origins are going to show with this example, but pasture and fence upgrades are also a possibility. Or maybe you have a property that has some pasture and some cropland. Maybe you put fence around the cropland to graze the stalks or overwinter on some wheat. So that could be a way for you to make the land a little bit more valuable to your operation, but also maybe someone down the road might be looking for. Randy, I think about this slide. I think about all those TV shows in the 2010s about these people who would buy and flip houses, right? They would look for houses
Yeah.
that were in short sale or nearly recently foreclosed on or at an auction, and they weren't the best houses, and they would put a lot of money in. They put some money in them to make them more curb appeal. And so I think some of those strategies that they were doing before we saw the renovation side of it is sometimes what goes into this. Not nearly as much drama or as short of a time frame, but I think this idea of like how do we put together a strategy that allows us to buy land that's going to give us a big return. You're probably going to have to do quite a bit of management to get that done. You're not going to be as passive with this strategy.
Yeah, yeah, that's a good point. You have to really know the land. You have to know that property, understand baseline where what it is and what it could be, and its flaws and positives. Because there's actually I've seen quite a few horror stories about individuals and funds and individual investors who have purchased a farm thinking it would fit this, or they thought they had a really good farm and they found out that the center pivots were not good, or the wells were not good, or it wasn't as productive because the drainage wasn't working, or whatever it was. So this one points out in order to put this into place for a big return, you really have to know what you're buying. And typically farmers do know that. Others have to do that management homework.
One that I think might ring true to a lot of folks today is I want to get a low cash flow burden, right? I want to try to get into a situation where payments, those debt payments I have to make are about the same size as that rental income that I might be able to generate. And so, if you find yourself or you're working with a client who wants to buy farmland but doesn't really want to have to subsidize this on an annual or recurring basis, the reality is you're going to have to be in a really strong financial position to go into this acquisition. So, some of the specific strategies that will work well is you got to be in a position to maybe make a big down payment. Randy showed how a 50% down payment might be more appealing than a 35% down payment, maybe even more than a 50% down payment. So that could be one way. The other way is maybe there are some creative arrangements that have to be made for this to work out. So maybe there's a purchase with a lease back. So the farm tenant already knows the land and they want to pay a high rent. So maybe you can purchase it and they're willing to pay a high rent to get that back a little bit. Or maybe there's a family sale type of arrangement here where somebody wants to keep it in the family. So they're going to maybe offer it at a little lower value. And you're kind of implicitly agreeing to keep it and maintain it and keep it part of that family legacy. I think the third idea here is you need to build a cash flow plan before ever evaluating any opportunity. This idea of, what is the actual number that I want to contribute on an annual basis? What's the actual number that I want to contribute from a down payment standpoint? And make sure you have that in place before you go find opportunities that might fit. Sometimes we get that flipped around. We go find farmlands and then we do all these analysis, see, can I get it to work? And sometimes it's hard to be disciplined when you start with the farmland and then you back your way into a plan. If you start with a plan, this is going to help you stay a little bit more disciplined. And again, Randy, I'll let you talk about this other one, but maybe some fractional ownership opportunities might be a way for this to work for you in your situation.
Seems like there's some newer and often emerging new ways to split ownership of farmland or share in it. This fractional ownership. Some of those happen again in the family arrangements and can in successive generations. There's real estate investment trusts or REITs that are available to. There, you might trade some land for some shares of that REIT, but still, they'll say the farming heir, the farming child, still be able to farm it, lease it back, some things like that. There's some that will actually, form partnerships, and you can own a fraction of that partnership that owns the land and still be the tenant. That might even work in a family situation if they wanted to do that. And then of course, there's the newest ones that, take much smaller investment to own a share of a farm. And maybe as a farmer, you can't afford to buy the whole farm, but you could buy kind of a significant fraction or a share of it that way, and get to still farm it in the deal that was made in this whole, buying and selling. And at some further point, have the option to buy 100% of it when that investment fund closes it out. So there's still emerging new ways to do that. They have to be evaluated by each buyer, seller, the farm operator, whether they work for them, whether it make financial sense, whether they're profitable, and whether they fit into their long range plan. So, they're not an answer to everything by any means. And I advise to, look at all the details very closely before they get into some kind of a fractional ownership. But there are options that maybe work well.
All right, Randy. So I'm going to wrap this up, and we're going to all the Q&A here that's been. So I see a couple questions already in. Make sure you submit your questions if you want us to get to it. But I want to wrap up here with this again. I talked about earlier about positioning is better than predicting, but in a longer form, successful farmland purchases are less about being right about where future farmland values are going to go or about them being higher, but more about having a plan that matches your farm or individual financial position, thus the earnings, the cash flow, the balance sheet position. So you want to match the farm's financial position so that the operation can absorb whatever unfavorable outcomes or unfavorable risks might be looming out there. So really think about this positioning. I think if you're going to be out there making a purchase of farmland, especially in today's market, really think about this positioning, how you can have some resiliency and maybe some anti-fragility to get through whatever those future shocks might be. Next episode is coming up on May the 28th. We're going to be talking about that summer market rally. Is it a mirage or is it a reality? Again, we're going to be swinging pretty quickly into this growing season. We're going to be talking about the 2026 crop. A lot of focus and interest as we get into June and July. And we want to help you think about the implications for your specific operations marketing plan, or maybe some of the conversations you're going to be having with your grower clients. And so that's coming up next month. Of course, be sure to register to join us live and get all your questions answered. But of course, as a premium subscriber, you'll have access to the recording and the slides as a follow-up to that. So Randy, I'm going to wrap it up here. We're going to move back to the last phase here, this Q&A phase. And one of the first questions that I had here, I'll cue this up, and if you have I have an answer for it, but if you have one, you can jump in as well. For farmland values and where farmland values kind of sit today in 2026, what are the key factors that you're going to be keeping an eye on and you're going to want to keep your pulse to the ground for? I'll jump in here,
Yeah,
and
you
I think
start that one. Then
I'll start this
it's a
one.
big
I'll
one.
start this. It's a big one. I'm keeping an eye on interest rates, and the reason why I keep my eye on interest rates is I think that there is an expectation. Our expectations around interest rates are that they're going to come down. I think a lot of the work that we've done shows, at least most currently, the argument for the Fed lowering interest rates is getting more difficult, especially with all these inflationary concerns. I also think that uh, the opportunity for farmland interest rates or farm interest rates to move lower is also extremely limited. We've talked about that in other recordings and other articles. And so I think even if the Fed lowers rates a little bit from here, farm level rates might not change very much at all. And so I think that we have this expectation that farm rates are going to go down lower. We see that with that cap rate scenario that we talked about earlier. And I think if we don't see rates improve, or maybe we see rates tick up a little bit, that could be a little bit of a shock to the farmland markets. We haven't seen the farmland markets adjust to that. And so I think cash rents could ebb and flow. Government payments are affecting cash rents. Commodity price expectations affect cash rents a little bit. But I think this external factor of interest rates is completely outside of the ag sphere. Agriculture can't affect it very much, but it does have a huge impact on agriculture.
Yes, I start with kind of a really too broad of a point is the uncertainties. And I think the uncertainties in so many levels are and factors are impacting where farmland might go or where it is right now. The uncertainty of farm incomes, lower farm incomes, steady cash rents have not affected really farmland values as much as you would think with the stress that's in, on crop incomes for various reasons. We saw kind of a similar thing back in the 2014 to 2019 era when incomes were down. Farmland values dropped, but not as much as people thought because other things, low cap rates, low interest rates supported it. We still have the low cap rates. Cash rents are staying steady because, oh, there's government payments. I don't want to lose acres, a lot of reasons. But the uncertainty surrounding the outside influence, as you mentioned, interest rates, I think that's supporting commodity prices and land values right now is that uncertainty in the world outlook. What will fertilizer prices and shortages do around the world to commodity needs and so forth? What is the outlook for land as a safe, secure, long-term investment? I think has certainly got a lot of press, a lot of interest, a lot of promotion by investment groups, advisors, and so forth. So farmland, once again, I think is taking stage as a good investment vehicle. I think that is supporting land values, and will that continue um, or lessen in the future is one of the things to watch. Is that going to hold true, or that it's the great investment, the latest thing that everybody wants to get a piece of, or will that change because of other reasons? So that uncertainty surrounding that portion.
That's a really good point, Randy. I hadn't thought through that. You're right. 2014 to 17, we knew the budget was pretty bleak. We knew everyone was going to have to do some trimming. We knew where ARC and PLC payment potentials were. We knew where we were standing. And so it made sense to either negotiate rent lower or walk away from it. But now I think there's a lot of FOMO and uncertainty. So fear of missing out plus uncertainty, where there could be more ad hoc government programs. There could be lower interest rates in a year or two. There could be. And so I think this is what's led to some of these cash rents and even farmland values not adjust very much here. This is, I guess, the second question we have. If kind of last call, if you have a question, be sure you get it in. This is the last one we have, unless you get another one put in. Is one assumption was between the relationship was the relationship between farmland rent to value and the interest rates paid. How closely are those correlated in actuality throughout history? So that's more of a question for me in that chart that I had there. It's a great point. Like I said in the presentation, we're at a point in history where they're not. They haven't followed each other over the last couple of years. So interest rates have gone up, or the cap rate has stayed low. That's sort of an extreme out case. That's extreme case that's not favorable for the farm buyer. But in general, we find that those to be a pretty well correlated. So that 10-year treasury is pretty strongly correlated with farmland cap rates, or that cash rent to value ratio. On any given year, it'll be a little bit or above or below that 10-year treasury relationship. But I think if you think about farmland values over multiple years and decades, if not generations, it's a pretty good rule of thumb. Now, you're going to be in markets that don't exactly align with that, but I think it's a good relationship to keep in mind and to be monitoring as you think about your farmland acquisitions. All right, Randy, that's all the questions that I see. Any final thoughts or comments before we wrap up?
I think this is a good point that whether somebody's already whether they're a farmer, lender, or advisor working with farmers or individuals wanting to buy farmland, this was a good reminder of the basics and the economics and the financial work that needs to be done in order to make that land purchase work. And whichever place you are in it, I think it's a good exercise to think through and have the powder dry, so to speak, for when that once in a lifetime or the right farm, or I've got the resources, the ability to buy that farm and I want to invest in it for the long term. And, land's a long-term investment, but you need that short-term financial resources to get it paid for to reach that full benefit in the long term.
Great summary and wrap up, Randy. Thank you so much. Thanks, Randy, for joining me and helping me pull together the slides. Thanks so much to you, the viewers and supporters of AEI Premium. We appreciate it. We look forward to all the questions you might email to us in the weeks and months ahead. And we look forward to joining you on the next episode of the AEI Premium Breakdown there in May. Till next time, stay curious.